Welcome to the deep dive video update. This is a video that I do every week where I want to explain what I mean by this video. I do a video each day. I do a number of different weekly videos. Then one of the last videos that I do over the weekend is I look through all of the charts and I say, okay, what charts didn't I really talk about this week or I'm not really focused on right now? And I put them into this video. And the reason why I call this a deep dive video is we have to look deeper to see, are we being told anything that maybe we're missing with these charts? Now, there's a lot fewer charts in this week's video because the market's been going through some difficulties as interest rates are going up, and I'm having to use some of those charts in the daily videos. But then there are additional charts that I have in this video that are just for this particular video, mostly for informational purposes, just to give us an idea of what's happening. We don't use them to make decisions. We just say, okay, now I understand what's going on here. This can feed into my overall picture that I use to decide whether to buy or sell, whether the market is going to go up or it's going to go down. Okay, this is being prepared for Monday, January 13th. This is an informational chart. Now, I do a lot of studies on the VIX and a number of different charts, and a lot of those are being used in the video right now. But this one just gives us an overall idea of what is the range of the VIX over a period of time. Goes back to about 2005 over here on the left. Right now, we're in a lower range. Even though we've been turning back up lately, the market's been under pressure, so the VIX has been going back up. But when you take all of this together, we're in a lower range. And that's what happens when we're in a positive environment. When we were up in a high range, this was during the great financial crisis. Another higher range, this was right after the COVID crash, and then 2022. So we'll just keep an eye on this and see if the VIX continues to go up and go into a higher range. That could mean the market is shifting over and looking more negative. Even though this is ticking up, we're still getting a pretty low reading overall. So we're not really seeing the VIX changing its characteristics right now. Then this is another VIX study that I do, but it's not telling us all that much. It's a correlation between the VIX and the S&P 500, and we're getting a low reading. It's coming up a little bit, but when we really pay attention to this is when we go above the dashed line. This says the market is getting rather nervous because the VIX is getting a lot higher than the S&P on a relative basis, and the market is not really comfortable at that time. But since we're getting a low reading with this, even though it's coming up a little bit, it's still not at the point where I say, oh, look at this chart. It's really telling us something. Then we, just for information, usually we look at the VIX, and then there's another kind of indicator of the VIX called the volatility of the VIX of the VIX, and we do a ratio between the two. In a general sense, when this is going up, the market's going down. That's what happened in 2022. Then, as this has been going down, the S&P has, for the most part, been going up. Now, it's been kind of choppy lately. It's not showing an awful lot of conviction. It is going back up a little bit, but we just keep an eye on this. And then if it really starts to move one way or the other, then that's when I use it in the daily video. We also like to keep an idea on how fast is the VIX moving, and I use an RSI based on 9 periods to measure that. We're a little bit above the midpoint because the VIX has been going back up because it goes in the opposite direction of stocks, but we're not getting an extreme reading, either above 70 or below 30 right now. I only show this chart when we're getting an extreme positive or negative reading. Then we look at the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And we had been declining here, which was more positive for the market. That means that stocks were less volatile than bonds. But now we're starting to go back up a little bit because bonds are under pressure based on price, and lately stocks have been under pressure as well. And that's why we're seeing these readings going up. I mainly follow the red line, which is a moving average, to give us more of a general tendency of what's happening. But we can see that just on the daily charts that we look at. As bonds and stocks have been going down, volatility has been going up. So we don't necessarily need this chart to tell us what we already know. Then this goes in and out of the daily video kind of on an as needed basis, but we've been chopping around recently. This is a ratio between large caps, which have been holding up better, and that's why this ratio has been going up, versus small caps, which should be doing really well right now, but are actually going down, and just measures, okay, what's in favor right now. And it still continues to be the large caps, but since we're not really moving with a lot of velocity with this chart, I stopped using it in the daily videos. But if we do start moving, then I will put it back in the daily video. This is just for information, just to give us some benchmarks to work off of. Even with the declines that we're seeing right now, we're still up 20.93% from the previous all-time high set in early 2022. Then we hit a low in October 2022, and we're up 66.75% from that low, even with the recent declines. And then we hit another low in October of 2023, and we're up 41.99% from that low as well. So, again, we're not using this to make a decision. It's just to look back and say, oh, how have we been doing since we hit major points in the market in the past? Then stockcharts.com does come out with technical alerts, and these are generated every day, and I go over them in the daily video. These are all the charts, or excuse me, all the alerts that we saw over the last week. And we start at the bottom. That was Monday, and then we had Tuesday. Wednesday was a really slow day. The market was closed on Thursday. Excuse me. And then we had a pretty significant down day on Friday. And you can kind of see just by looking at the color. Well, let's see. Monday was pretty positive. We see a lot of green or blue here. Tuesday, not so much. We had a down day, so we saw more red. Wednesday was just kind of choppy, and then we had a down day on Friday, and you see an awful lot of red here. Then what stockcharts.com also does is they take a chart and they rank it on a scale of 0 to 100 based on technical analysis indicators. The higher the score, the better looking that particular chart. Well, you can use that with a stock, a sector, or even a mutual fund. I use it for indexes, and I look at five main indexes. The S&P, which is the foundation of what I do. Keep an eye on the Dow. That's considered to be the best stocks that are in the stock market. Then we look at the NASDAQ 100, which is pure growth. We also keep an eye on the mid caps and the small caps, and then rank them. See, okay, which, based on a technical analysis score, removing all emotion, which index is performing best? Well, even though it's been coming down lately, this week, the QQQs, which is the ETF for the NASDAQ 100, it's coming in first place. And you can see we get the last few months here of how these scores have unfolded. And then because the Qs are going down, the score is going down. When we're really strong, the solid indexes will be into the 90s. And since we're going back down, we're now at 76. But even with the other weakness that we've been seeing in the market, the Qs are still holding up the best, even though they lost their 50-day moving average in Friday's session, and that is a concern. In second place is the S&P 500, is represented by the SPY, coming in at 70.5. Now, the stocks that are in the NASDAQ 100, they're in the S&P 500 as well, but there's 503 stocks in the S&P. Some of those are values, some of those are longer companies that aren't longer term companies that are not considered growth companies, are considered better value companies. And so the S&P tends to be more balanced. When we're going down, it holds up a little bit better, and it lags behind when we're really going up. But it comes in second place this week at 70.5. Then we have the Dow, which are considered to be the best of the best stocks. That's coming in at 58.8 as it's been under pressure lately. The mid caps are next, coming in at 49.1, not really going up because we're seeing a higher interest rate environment, and this really affects the mid caps. And now in last place, which should be in first place, according to what everybody thought was going to happen, are the small caps, as represented by the IWM. That's the ETF for the Russell 2000 small cap index. And it's really dropping off. And a lot of that weakness came on Friday. And they're not, at least to this point, experiencing what's called the January effect. Now, when we look under the surface at small caps, mid caps, and even the S&P, the growth to value ratios, they're holding up pretty well. And I go through those in the intermarket analysis video. I also hit that each day in the daily videos that I do. But there's a lot of disappointed people right now because they got into these small caps thinking that they were just going to automatically go up. Well, with this rising interest rate environment, it's small caps that get hit by higher interest rates the most. And that's why they're actually going down. They were chopping sideways and they've been range bound for most of the last year or so. They have a nice upward move and then pull back. And then they go back into that range for a while. Now on Friday's session, they actually broke more to the downside. But the not the Russell 2000 index, but the S&P 600, which is the S&P small cap index, it's right down to its 200-day moving average and was able to bounce up off of that. So are we going to get some support from the small caps right now? Now, I don't have that chart to show you. Go over and look at the daily video to see that, but these are just different things that I look at. When we're really going up, I'm looking for negative things because the positive is very clear to see. When we're going down, the negative is very clear to see. So then I start looking for positive things, and that could potentially be something positive that we're at support for the small caps. Okay, in the short term, then I have a rainbow. And the reason this is short term is I use shorter term moving averages, going from 10 periods up to 50 periods. And for a large part of 2024, we've been above the rainbow and the rainbow's been going up. Well, now this is starting to get all jumbled up as we're dropping down below the rainbow. Intermediate term, another rainbow. This is more looking first we look at the short term, then we look at the intermediate term, and this chart goes from 50 periods up to 100 periods. Also coming down into the rainbow, we haven't quite dropped down below it. The 100-day moving averages, which I have been showing in this video for months. Now that's come into play. So now that's switched over to the daily video because that's the next support level that as of Friday has been holding. We came down to that 100 period moving average and we closed up off of that. Will that end up acting as support? When we're really going up, often the 20 period moving average will provide support. The 50 was providing support for a while, then we lost that. Now we're going down to the 100. We look at Bollinger Bands, and as I say every week, there's thick books written on just how to use Bollinger Bands. This is one implementation of Bollinger Bands. It's a thing called the percent B indicator, and it measures when we're either above the upper Bollinger Band or below the lower Bollinger Band. We're not there, and that's what's measured down below. Now, we're more negative since we're below the midpoint, and we're coming down with the lines here, but we're not getting any kind of an extreme reading currently. CMB composite, I use this like an oscillator when we get an extreme positive or negative reading. We're not getting that now, although this is coming down, so it is negative, but we use this when it gets below this black line on the bottom or above the black line on top. Distance away from the 200 period simple moving average coming down as we're getting a little closer to it. We're still well above it since this is green. So we just keep an eye on this. This will come into play if we see more weakness coming into the market and we drop below the 100 period moving averages. And this is also for information. It's kind of trying to elaborate on the chart that I showed earlier. How much are we up from the lows? Well, going back to the October 2023 low until Friday's close, we're up, and I wouldn't trust this number. I would go look at the previous number. We're still up over 30% based on this. Now, what I'm following in here is when we hit a top and then start to come down, how much of a percentage are we actually declining? And that's what we're keeping an eye on here because we set an all-time high earlier in December and we haven't got back to that high yet. And if we continue to fall, if we get down to that 10% level, that's if the smart money is going to make a stand, that's where they're going to make a stand. And they did that last summer. We were really coming down. This was the end of the world, these couple of days when everything was falling apart. Well, we finally hit a bottom and bounced up out of that. Well, we're at 4.65% from the all-time high here now. If we continue to fall, if we get close to that 10% and we don't see the smart money coming in and buying, that means things are probably going to turn more negative and we're going to fall further than 10%, which that's the definition of a correction. Right now, what we're just seeing could be classified as a pullback. Another oscillator called the Connor's RSI, it's very spastic on a day in and day out basis. We're not getting any kind of an extreme positive reading now, so I don't show this chart. Then these are anchored moving averages, which are a variation of the regular moving averages, which use historical data to calculate the current value. Anchored moving averages try to look at the current value and then, based on what's already happened, project forward. And when we're coming down, these can act as support levels. Well, we fell underneath this one anchored moving average, and we're still kind of far away from this orange one. Now, we're still positive longer term because even though we've been coming down, all of these lines continue to go up. And some of these go back pretty far, where others are more recent. When I draw these charts, I go to some kind of a low or some kind of a high and then send the anchored moving average going forward from there. And because sometimes that can provide an area of support or resistance. We want to keep an eye on the S&P 100. It's been outperforming. Those are the biggest stocks that make up the S&P 500. But on a price chart, we're not really seeing much of a disconnect between the two. Then we have a long-term rainbow where we're coming into the top of it. This goes from 50 periods up to 250 periods. And we haven't been in here very long, so the lines aren't really starting to roll over yet. The longer we stay in here, or if we continue to decline, this could suggest that the longer term trend is in jeopardy. Just to give you an idea, we were looking really solid at the end of 2021. All the lines were going up and price was above the lines. Then we started to see some weakness and we fell to the bottom end of the rainbow. We haven't done that yet. Then we stayed inside the rainbow with more weakness. And then we finally started to roll over and actually switch to more of a negative stance. Now, this can take a number of months to play out. This is the long-term trend. So we're keeping an eye on this and we'll evaluate this. I look at this every day and then I do the weekly videos and we'll just see, are we seeing the general long-term climate switch over to negative? For right now, it's still positive since all the lines are still going up, but we just want to watch this to see if things are changing. And this is a long-term oscillator called a special K. Even though it's coming down, it's still above this red line, and we don't get very many signals from this. So I just look at this every day, but I don't really talk about it unless we see some kind of a cross above or below the red line. And we want to keep an eye on how are things going in the US compared with how they're going in Europe, specifically in Germany. So we have a chart of the S&P on top, that's the US, and the German, that's EU, but the German market's the biggest stock market. And we see that even though it's coming down a little bit, there's a pretty strong correlation between the two on a longer term basis. We're not really seeing things out of whack right now. And some support and resistance. I did show this earlier in the week. This is a 20 period simple moving average of the open, high, low, and close. And they're different colors, so it creates what I call a mini rainbow. And we came right up to the green line, which is the simple moving average of the high. And we have not been able to break above that. And we're setting a lower high here. We also set a lower low. Then we set another lower high, then another lower low on Friday. That's making us a little bit concerned about how we see price playing out right here. But for this chart, we're below the rainbow. The rainbow's going down, so that's negative for the short term. And since we're far away from these lines currently, I stopped using this chart in the videos. We also want to keep an eye on the fib retracement levels going back to the all-time high. We're still far away from this 38.2% retracement level, but if we continue to fall, this chart will become very important. Some broad market measures. This is the Vixen, which is the VIX for the NASDAQ 100. It measures volatility. I don't use this all that much. I know some of you that watch these videos do, but we have been going up with volatility because the NASDAQ 100 has been under pressure lately, just like everything else. And then we look at the S&P on top, and then we do a ratio between the Qs and the Dow. That's growth versus value. Now, NVIDIA is in the Dow these days, so there is a growth stock in there. And then we look at this ratio and then we look at the correlation between them, and they're pretty strong. So we have the S&P going down. We have the ratio from growth to value also going down right now. So we're not seeing anything that's really out of line at this point. Then we look at the transports and compare to the Dow. The red line is the transports, the black line is the Dow, and they both have been under pressure lately. And this is a little bit of a concern because the financial sector as a whole is still positive, but it's been getting hit pretty hard lately. It's dropped under its 50-day moving average. Well, inside of the financial sector is the bank ETF, and it's also below its 50-day moving average. It was holding up okay as it was chopping sideways, but it broke to the downside on Friday, so it's turning a bit more negative. Then we look at the regional banks, which are the smaller banks, and we compare it to the financial sector. That also took a hit too. Now we're still in an uptrend here, but we've been going sideways. We just want to keep an eye on this. If there's any more, especially with interest rates going up, there's a lot of refinancing that's going to happen, and that could impact the banks. And the banks, they've got this cash, and what are they going to do with this cash? Are they going to still hold on to government bonds that are paying almost no interest? Or are they going to have to shift over to bonds now that are paying higher interest? And how's that going to affect our earnings? So we just want to watch this. Then the staples to tech ratio, there's sometimes I show this every day. I dropped it for right now because it's been very choppy. But for the most part, we're still going down right now. We still have a downtrend, meaning staples, defensive, are underperforming tech, which is growth. And in a positive environment, we want to see this ratio continue to go down, even though it chopped up a bit in Friday's session. This is for information. This is longer term. Usually I base my long term definition around the 200-day moving averages. This goes out a little bit further to 250 days. It's a rate of change, and we are coming down, showing some weakness in the longer term trend, but it hasn't shifted over to negative. This is also a longer term look going back to 1980 with the long term trend. We have been above this blue line as we were going up and the market was looking more solid. Now we're dropping back below the blue line and declining. But like I said, we wouldn't switch to negative on this chart unless we come all the way down and drop below zero. Bonds, we're looking at the interaction because interest rates are going up and they started to go up right when the Fed started to lower interest rates. So we have different things going in different directions. Now, the Fed controls short-term interest rates, where the interest rates that we're seeing really going up are further out, like the 10-year bond and the 30-year bond. Well, we look at the ratio between cash, meaning just money you carry around with you, and the 3 to 7 year bond. And when this is going up, that means there's uncertainty about inflation. There's uncertainty about interest rates. And that's what we're seeing played out in the market. And until this turns, it starts to come back down. That's going to be a concern for the market. So this is a shorter term look at how interest rates are impacting things. Then we go to more of a middle look here. This is TIPS, which are Treasury inflation protected securities. This isn't seeing much of a problem right now because these TIPS, they adjust for inflation. And when interest rates are going up and inflation is going up, you would see this ratio really going up. Now, it went up on Friday because we had the employment report come out and it was a lot stronger than expected. So you got the market freaking out. Interest rates are going up, and tips actually outperformed in Friday's session. But when you look at the bigger picture, they're underperforming when we look at them compared to 3 to 7 year bonds. So this isn't necessarily a concern right now. Now, if this continues to go up and we are just generating a death cross here, which would be positive for stocks, but we generate a golden cross and we go back over positive with this ratio, that's going to cause some more concern to us. But this is a little bit more of a concern. We take TIPS, which are Treasury inflation protected securities, which adjust, comparing them with further out bonds, 7 to 10 years. This is going up, and this is causing some concern, and it's in an uptrend here. That means that inflation worries are starting to go back up because interest rates are going back up. So this is part of the battle that the market is fighting right now. Then we look at the long-term bond in blue, which has been going down based on price, and the S&P, which lately has been going down based on price as well, but it's been outperforming longer term. And we look at the long-term correlation, and it's getting stronger. So we look at the long-term price of bonds compared to the price of the S&P, and the correlation is kind of strong right now, and it's improving also on a shorter term basis. And we do that same thing with the Qs to the long-term bond. Only on this chart it's red. We're back to neutral pretty much with this because the Qs have been really outperforming the price of the long-term bond ETF. And so we saw this correlation actually going in opposite directions. But now that the Qs have been coming down and bond prices are going down, this relationship has improved, but it hasn't crossed above the midpoint yet. Then we look at, and this is kind of interesting. Somebody sat around and actually thought this up. You take the 10-year yield in the US and you subtract the German 10-year yield. And since US rates are higher, we get a positive result. And then we plot the US dollar index down here, and we can then correlate the top chart and the middle chart with each other. And it's like, wow, okay, yeah. And there's a pretty high correlation between the two, showing that how interest rates and currencies are interacting with each other is the relationship is strong right now. So we're not seeing anything really out of line here. And we want to keep an eye on the 2-year treasury yield where it's been going back up lately, and that could be pressuring stocks in the short term. Because sometimes when we come up and we hit a high reading with the 2-year yield and then start to go back down, that can provide short to intermediate term support to the S&P, but we're not at that point right now. Then we want to keep an eye on stocks in Europe because there's a high correlation between European stocks and US stocks. And we compare it with American bonds that go from 3 to 7 years. And we're down at the lower end of the rainbow, and we're starting to really roll over here. This isn't really looking positive, but it is improving after it had been looking a little bit more negative. So we're not really getting much insight here. Then we look at the 10 to the 2 yield curve, which for more than a couple of years was inverted. That's when it's below the blue line. We're back above. And when we go back above, this is when we start the countdown to see, are we going to go into a recession? Well, not based on what happened on Friday, because one of the things that has to fall apart to go into a recession is employment. And the report was very strong. So it's pushing interest rates back up because they're afraid of economic strength, not economic weakness. But we like to keep an eye on this. And since this recently went back to being normal, I've been showing it in this video. And I also tracked the 10 to the 3-month yield curve, which was the last one to go back to being normal after being inverted for over 2 years. But again, this is part of the countdown to see if we're going to go into a recession. Then I have a number of things called possible positive scenarios. And I used these heavily in 2022 when we were going down, but I have a number of different charts that make up this section, and a lot of those are used in the daily videos. The ones that I don't use there, I put in this video. This is the percent of stocks above their 200-day simple moving average. And I have another study which measures the same thing, but I interpret it a little bit different. I measure something a little bit in a different way. I use this chart like an oscillator. When we get an extreme positive or negative reading, and we're not there. But then we're getting a little bit concerned here because we're starting to get really close to this 50 level. If we drop below 50, that's going to turn things longer term more negative. Now, not the trend. It's just going to show that there's weakness developing in the long-term trend. So if we can maintain things above this 50 level, that would keep it more positive. If we drop below, that's going to turn things more negative longer term. We do that same thing here with stocks above their 50-day moving average. And that's getting a very low reading right now, not down enough, at least yet, to cause us to use this like an oscillator, but we are showing weakness and also getting a low reading here with the mid caps as well as the small caps. So there's still more room to run before we get really extreme negative with this, but it's negative in and of itself because it's below 50. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.